wasn't that long ago that the Fed lowering interest rates from 6% to 1% caused the yield hunger games to kick off what happened in 2007 and 2008. Now we've had yields on treasuries, short-term interest rates lower than that for more than a decade, and the Fed is still talking about potentially lowering rates again. It's a recipe for financial disaster. It's unbelievable to me that people cannot remember 10 years ago when the exact same thing happened, and this is only worse.
Well, I mean, we just got more data today that's concerning. You'd agree with that, right? ISM manufacturing under 50. Markets banking on the Fed coming to the rescue in its meeting in a couple weeks and thereafter.
Big mistake, if you ask me, and because I know I've been listening to the show. It's very interesting. You're talking about opportunities in the stock market, but people have to focus on the bond market, which is 4 times bigger approximately, and it's replete with risk now. I mean, returns on the high-yield bond market index is like 5.5%. That's absurd. Those bonds should be yielding 10% or 11% to account for the risk of the companies that are issuing them. Yes, it's a great time to be an issuer of debt. Yes, lenders, borrowers are getting away with all sorts of things. But it's a huge mistake because the people buying those debt securities, again, 4 times the size of the equity market, are taking huge amounts of risk. And when the economy hiccups a little bit, which it inevitably will, all of that is going to come a cropper, and people are going to lose trillions of dollars. And then the credit markets are going to freeze up. When the credit markets freeze up, forget it. Nobody can get access to capital. Forget it, 2%, 3%, 8%, 10%. Nobody can get access, and that's when things really go down the tubes and fast. You talk about confidence.
You make a comment about the July rate cut, which you say was a mistake, and then you say, quote, Mr. Powell and his colleagues at the Fed need to stand up to Mr. Trump and do what's right for the economy. If they don't, the only question that remains is when will it all blow up? When it does, and that day will be soon, we will be staring down yet another financial panic. That doesn't feel a little hyperbolic?
Well, not to me, Scott. I mean, I've written 2 books about the 2008 financial crisis, one about the collapse of Bear Stearns, and one about how Goldman Sachs avoided going down the tubes. This scenario happens over and over again, and new investors just do not have the memory for this. It is so distressing. We have financial crises in this country basically about once every 20 years, and it's always the same scenario: borrowing short, lending long in the banking system. And yes, the Fed to some degree has pushed some of the risk out of the big banks into the shadow banking system. But as I say in the piece, the risk doesn't go away. It's like the air that we breathe but can't see. The risk is out there everywhere. When the high-yield bond index is yielding 5.5%, people are overpaying for the risks that they're taking and the rewards that they're getting. And this has been going on for 10 years.
You seem to imply in the example that I just read that the Fed lowered rates in July, that Powell bowed to President Trump's demand that they cut interest rates. Is that what you are implying by saying and then calling it a great mistake?
I'm not even implying it, Scott. I'm saying it. He did cave to Trump's pressure.
But what was he supposed to do? What was he supposed to do with the trade war that's having a real impact on the economy?
Not lower interest rates. He's inviting people to take more and more risk in the much bigger bond market than currently exists. We've seen this is exactly what happened leading up to 2007 and 2008, and we're doing it more. This time, it's been going on for a decade, where interest rates are being kept manipulated down low. And don't believe, Jeffrey Gundlach of DoubleTree, there's so many people who out there, Double Line, agrees with me. This has been going on for way too long. Jerome Powell should say, enough. I am not going to cave to the president wanting me to lower interest rates. I'm going to do what's right for the economy. I'm going to gradually increase interest rates to give debt investors a return for the risks that they're taking so that bond prices begin to fall and interest rates go back up. And that will, in effect, stave off what will definitely be a financial crisis. Yes, it might result in the economy slowing a little bit, but isn't that better than a complete financial catastrophe like we had in 2008? I would subscribe to that and say, yes, absolutely. Let's foam the runway a little bit here. They're not foaming anything. They're like having a head-on crash back into the runway.